Well, good evening, everybody. This nice autumnal evening as we enter the fall season all around us. Welcome to the September 2019 edition of the Investing Roundtable. My name is Mark Robertson. I'm founder and managing partner of Manifest Investing, one of the co-sponsors here of this event. I'm joined by my two dear colleagues, Cy Lynch from Atlanta, and he'll remain a dear colleague despite that my Cardinals will face his Braves here in a few days in the playoffs.
And we're looking for revenge for the infield fly game.
Yeah, I figured as much, and we'll get to do it over a series this time, Cy. So
Yes.
good stuff. And we're the giggling you're hearing in the background is from Ken Kavula of Mid Michigan. Good evening, Ken.
Good evening, Mark. Good evening, Cy. It's great to be here this evening.
Did you
It was
see
a gorgeous day here in mid-Michigan, I'll tell you.
So when
Go
you were
on.
up north, did you see any of the changing of the colors beginning?
The colors were just beginning. We were getting some bright scarlets from some of the sugar maples, but for the most part, that's all there was yet. So we're going to take off again early next week and go do some color peeping in some of our favorite spots. But it should be hitting the peak in the top of the lower peninsula next week is what they all say.
Okay, well, let's go ahead and get underway. We don't have any overarching theme tonight other than kind of an answer to the political question that came up in the green room about impeachment and effect on stock markets and volatility and all that kind of stuff. Our message is just incredibly boringly the same, and it just simply works over nearly 8 decades. That's keep doing what you're always doing. That's always discover really good companies, excellent companies, and buy them when they're on sale and hold them for as long as it makes sense to do so. It's incredibly boring, but I don't know. I have a lot of fun with that. I hope you guys agree.
Absolutely. The invest regularly part of our set of rules just should speak to everybody, and that's the key, I think, to long-term wealth.
Amen to boring.
All right, so let's go ahead and get the legal paperwork out of the way. No investment recommendation whatsoever is intended. This is all about demonstration. We're here to share some thoughts on a few specific companies. We do this for illustration, education, and demonstration only. We do use the methods of the modern investment club movement as promulgated by the National Association of Investors, Better Investing, and or Manifest Investing. And we'll try to let you know if we own anything. If you'd like to have friend or family or yourself reminded for when we hold these events, we hold the roundtables monthly. We hold some intermittent periodic educational sessions on investing related topics from time to time, but you can email nkavula1@comcast.net if you'd like to be added to that list. If you have follow-up questions after the session or you want copies of the slides or anything else, Mark R. at manifestinvesting.com. Thank you. Here's our standing agenda. We've been doing this now for over 9 years, pretty much the same. We do take a look at what we've done. Welcome, everybody, by the way. We do keep score on and track the performance of the selections that we make. And we'll take a look at that in some greater detail. We've actually made incredible progress in turning this thing into a less a tracking portfolio and a real portfolio. I don't know if you guys were aware, but we're down to like 65 or 70 companies in the portfolio itself, and it's become more like a regular portfolio, even if it's a fat one. There's the companies that will be presented tonight. Hugh is traveling and probably will not be joining us. He might drop in if he gets to a place where he can. But 3 stock presentations, ULTA Beauty, EPAM Systems, and FedEx by the 3 of us. We do open the floor for a poll at the end of the 3 stock presentations, and then we do stick around for a few minutes, time permitting, for some open Q&A. Here's just a reminder of what we've been doing on a monthly basis for 9 years and a couple of months. We are here just to share some of our favorite investing ideas for further study. We do tolerate and embrace non-core selections. Those are special situations like some that we'll talk about, up to a maximum of 25% of the total portfolio. We do aim to beat the long-term return on the Wilshire 5000 as the representative index or benchmark for the total stock market by 5 percentage points over time. And we'd like to see over half of our selections actually beat the stock market from the time of selection. Here's a look at the performance graph updated through the close of business tonight. The rate of return on our selections since inception, again just a little over 9 years ago, is 16.8 percentage points. That compares versus the same mirroring type investments made into the Wilshire 5000 of 11.2. That nets us a relative return of 5.6%. Our goal is to, again, to beat it by 5 as depicted by that red line. And we're about half of the time outperforming the selections as we make them. So it's a good trend. We want to stay above that red line. We'd love to advance up towards double digits, but it's pretty exemplary performance over time, and we'll take it. Anything above 0 means it should be beating the market. So it's a very important thing to keep track of, and many investment clubs actually begin their meetings by tracking their performance on a relative return basis. So good performance, we'll give that internet standing ovation at this point. Here's the tracking portfolio itself. Like I said, it's down to 70-ish total companies. You can look at all 70 of them listed out at that link up at the top. It's a public link. We won't even know that you're there checking it out. What you see on your screen is the top 20 holdings by position size. So Microsoft is the largest position at nearly $30,000 in value that you can see in the center of the page. And again, these are the top 20. The way you decode these versus the legend up at the top, anytime a stock is selected by a knight, a damsel, or a guest knight or guest damsel, or the audience, we invest $1,000 in it. So Microsoft, if you just scan across the top, you can see that Microsoft appears. I'm not seeing it. There it is, right there. Microsoft out on the end has been selected 5 times. So $5,000 has been invested in Microsoft. That $5,000 is now nearly $30,000. So some fairly interesting, some community favorites top to bottom. You're going to hear more about Ultra Beauty tonight, Ken's selection, and Cy also is going to go with one that's currently among the top 20 EPAM systems. Any thoughts on the list, guys?
I'm just continuously amazed at how well some of these have done since our original choice, our original placement in the portfolio. This is an excellent set of companies.
Yeah, the one that's been really kind of interesting to watch, we'll talk about it if we have a little bit of extra time, is our Delex. That's been added to the portfolio several times. It's 6 times in, I believe. Yep, 6 times in for our Delex, and that's been close to $7 recently. It used to be pretty far down the list, and all of a sudden it was up in here earlier this week. In the past month, it's kind of come back off of its highs, but quite the story. Talk about a non-core or a special situation, that one certainly qualifies. But the one that really kind of grabs me is Global Payments, SCI. That's a single-time selection, one time. So $1,000 invested in Global Payments is now on this list at 8 something. That one's pretty cool. And they just picked up TSS, so they appear to be heading in some pretty positive directions.
And one thing I'll just throw out about Global Payments is that what was odd about it is it was very my pick there, and also I've featured it a couple of times in the Growth Stock Outlook Better Investing magazine portfolio article that I write. But for a long time, I noticed that Value Line was very negative on Global Payments. It just did not seem to make sense. So sometimes, going against and that also tended to pull the manifest consensus down at times as well. So
That's, in fact, we'll talk about that when I talk about my screening results tonight. That's fairly typical in many cases for early stage companies. Now, I don't know how early Global was at the time you're talking about, but you can see that with Morningstar, and you can see it with Value Line many times, that their expectations for some of the younger companies can be quite different than the outlook from the rest of the street. So we'll actually take a look at one case tonight. All right, a quick tour through the portfolio. We've really done a massive amount of spring cleaning over the last year or so. And tonight, the first thing we do, and it's kind of a standing practice, we think it's a best practice for any investment club to look at the stock that has the lowest projected return, the lowest return forecast. In this case, it's Dollar General. Dollar General has a return forecast of 4.5%, puts it on the hot seat. It's not terribly hot. I would say the burners are off. There's nothing wrong with any of these 5 companies, in my opinion. They're all very high quality, maybe a little bit lackluster on the growth, but as you look down at the portfolio averages, we've got a pretty good amount of growth in the portfolio. The weighted average is 12%, so we can tolerate just about anything. And the overall return is 4 percentage points above my par. The median return on the stock market is right around 8%. So checking in at 12.6, we're just a little bit light. We'll actually improve that a little bit tonight. But these 5, to me, qualify as pretty much core holdings. Dollar General might be the weakest core because it's a retail stock. But Ken, you've brought Dollar General a couple of times to the portfolio. Any thoughts?
Well, I consider it a core holding, as I do Costco and Apple for that matter, and I would not consider moving it out of the portfolio until our rules indicate that when a core holding moves down to money market returns, that might be a time to consider it. But at 4.5%, I always like to remind myself that that's probably plus or minus 2 or 3. So I think this has as good a chance to do about average as it does to do down around the 0.1-2%. So I want to keep this in the portfolio. What strikes me, Mark, is that for almost 2 years, this is the first report card that I can remember where our growth has exceeded 12%, our sales growth number. And we should be slapping each other on the back because we've been doing hard work to try to get that growth up to around 12%, and it's there right now. It's been a long haul to get it to that point, and you're right, the 5 companies that are on the screen right now have a lower sales growth, but we can afford to have those in the portfolio since the entire aggregate is up around 12.
Absolutely. And Costco, by the way, is another one-time selection, so that's only $1,000 invested. And Costco, actually, a selection made by Hugh 9 years ago, has actually done fairly well.
The only thing that I would add, I don't disagree with Ken's observations or yours, Mark, is for a tracking portfolio and for what we're doing, and we've been pairing a good bit, as you've mentioned, I don't have any heartburn with leaving any of these companies in because I would agree, certainly the first 3 are core and just based on their individual par would not merit sales. If this were a fully managed portfolio, however, par is 1.2 below my par, which is significant and does require corrective action.
And I would jump in and agree with Cy. I am looking at the percent of total, and we are looking at just about 10% of the portfolio in these 5 stocks, with over 6% of it sitting in Apple. So, but for the purposes of this portfolio, I say let's leave them for the moment.
Sure. All right, we'll keep cranking along, and like Sai is saying, we got to be always adding to the return forecast pile to keep that number bolstered. Something we never stop trying to improve. All right, the second thing that we watch for is any company that within the last year since being added to the portfolio has fallen 20% behind the market. There aren't any of those right now. We've lost a couple of them over the last year, but not too bad. By the way, guys, I don't know if you saw my fun fact on this or not, but the selections made during calendar 2019 have actually outperformed the market by 11 percentage points. So that's kind of fun. So we don't have any case 2. We actually don't really have much to go on when it comes to case 3, which is watching for quality degradation. Biogen is kind of a situation that I think we probably ought to kick around in a little bit more detail, if not now, certainly within the next month or so. You can see the price drop on the right-hand side. Those green price bars dropped off, and you can see the reason. One of their major prospects, their aspirations, actually did a face plant back in the first quarter, at the end of the first quarter this year, and it's been tough to get people interested in investing in Biogen pretty much ever since. And you can see that the quality has actually slipped down. It'll be interesting to see if it takes a bit of a hit in the next update. It's actually on the update list for this week at Value Line. Any thoughts on this one, either of you guys?
I'm trying to read the scale, Mark. Is that about an 82 to maybe a 79? Is that what that is?
Yeah, it actually broke through from excellent to good, dropping from the top quintile into the second quintile.
So it's about 3 points in quality, right?
Yep.
Yep. Okay. I would definitely want to see what it looks like after the next update, right?
But if it drops any further, I would think
Excuse me.
This might be one that we jettison.
Okay.
All right, and last but not least, we really don't have any stocks that are potentially overheated and potentially attractive for sale. And we watched the relative strength index just to see if there's some sentiment-driven action with a relative strength index greater than 70, and we don't have any that are actually at the other end of being, oversold to the point of becoming attractive. So, kind of a dry run through the holdings in the portfolio, and not seeing anything of merit. I don't think any one of those 4 is a screaming run for the hills yet either. Any thoughts on any of the 4?
The only thing that's interesting to me, and other than our monthly looking at it in this session, I almost never look at relative strength index. But what strikes me is the first 2 companies that are well above my par. I mean, they're not just in the yellow, they're pushing, 18 or so points above my par, percentage points above my par, and yet their RSI is pushing almost overbought. And that just strikes me as counterintuitive.
It is. The one thing that is unsaid is Health Insurance Innovations was featured in the Fortune Fastest Growing 100, which, by the way, Marie Frank has donated again this year. And they were number 1 last year. And anytime you appear on the cover of Fortune magazine, the price takes off. And then this one did an absolute Mexican cliff dive drop shortly thereafter, and it has recovered. So what you're looking at is some of the fairly rapid recovery with Health Insurance Innovations. So it'll be interesting to see how that looks longer term. All right, I think we should just go ahead and press on then. No major changes to the portfolio. Let's go ahead and get into our stock presentations. We can always cover more in the Q&A if somebody wants to kick something around. But go ahead, Ken. Let's go ahead and launch into your field of expertise from all of that in-depth personal research that you do. ULTA Beauty.
Well, two of my granddaughters are at college, so I don't visit these stores nearly as often as I used to. But I still have one, and we still do make forays down to the store and spend an inordinate amount of time walking the aisles. But I think that if I were to tell you that I have a medium-sized company whose last quarter net sales increased 12%, whose last quarter diluted earnings increased 12.2%, I think you'd say, well, that's a company operating near the top edge of where I would expect a medium-sized company to operate. If I told you that it was a retailer on top of that, and that comp sales, in other words, sales for stores open more than 18 months increased by over 6%, I think you'd be very, very impressed with what this store is doing. Now, you put all that together, they did update their fiscal guidance, but this was the numbers that ULTA came out with about 2 weeks ago. And ULTA came out with these numbers. They did update their fiscal 2019 guidance, and they got a haircut of over $100 a share in a little bit less than a day and a half, 2 days. I happen to think that that haircut was way overdone, and that we need to take a second look at this stock, which was trading at a PE in the mid to high 40s and now is trading at a PE somewhere around 19 or 20. Next slide, Mark. The new guidance, and I've copied the bullet point that stated the new guidance from the news release. It's up there on top of the slide. The new guidance for 2000, and I have a wrong year. No, I don't. That's 8.4 to 10.2 earnings growth over the 2018 earnings. And again, if I were to tell you this is a medium-sized company and I expect earnings to grow 8.5 to 10.5, I think you'd say, well, that's a really nice number for a really good medium-sized company. On top of that, they're going to be buying back $700 million in share buybacks. Now, you have to remember that this news release came out prior to the stock taking a big hit. That means that if the company goes ahead now and buys back shares of stock, it's going to be buying back shares of stock that are significantly cheaper than the anticipation when it put its news release together. So I think that share buyback based on a lower share price is going to have a lot more influence to the company and is going to raise that earnings per share guidance a little bit, so that maybe it's going to be 9 to 11 or even 9.5 to 11.5, something along those lines. So this is the case that I'm making for a stock that I own in a couple of portfolios, and I'm making the case about whether I want to sell ULTA at the low or whether I want to buy some more of what I consider to be a very high quality stock. Next slide. So the next thing I do is I put an SSG together, and this is an ULTA conservative SSG. I'm using numbers that are at the low side of all the numbers I can come up with from the analyst community. I circled the growth from the last quarter, and again, medium-sized company, 12% growth, what's not to like? I'm looking at the analyst consensus going forward for 2 years on sales. That's about 10. Long-term earnings estimates about 10. And when I compare those to numbers from other sources, remember the numbers in our source are coming from Morningstar. They're not right, they're not wrong, they're just one opinion. And when I compare all the set of different numbers, I find that these numbers are usually on the low side of where the analysts are sitting. So I did my SSG basically using those numbers going forward. A 5-year sales rate of 10 and a 5-year earnings per share rate of about 10 as well. I don't see any disruption in the sales line. If anything, it's slowing down just ever so slightly as the company grows in size. In 2009, I probably would have characterized this company as a very large, small company or a very small, medium-sized company. In 2018, I'm characterizing this as a good, solid-sized, medium company. And that sales line is exemplary. The earnings line kind of matches with it. So I'm pretty pleased with that. Next slide, Mark. I'm looking at some numbers on the back of the SSG. This is before the end of trading today. So when it closed on, let's see, today's Tuesday. When it closed on Monday, it closed at $237 a share. Notice how far down that is from the all-time high in the last 52 weeks, down from $368. The PE ratio has been trimmed considerably. The PE ratio is down to 20. And going forward in PE ratios at the high and the low side, I've chosen numbers that basically are lower than anything the company has done in the last 5 years. So I'm choosing a high PE of 28 and a low PE of 17. Remember, I'm trying to hold the company's feet to the fire. I'm trying to set very low barriers for success. So if the company meets these barriers that I've set for it, it turns out to be a buy. Next slide, Mark. And it turns out to be a buy with a possible return of somewhere between 12.5 and 17.5. Now, the par value, I need to remember, is the same as the par value that comes from manifest investing. So I go to ULTA's Chronicle. I don't see any disruption in quality. That's the blue line. And I notice that at the end of August, and that would be the last dot with the circle around it right there at the very right-hand side of the graph, that last dot is pretty much a historical high for the 4.5 years that this graph deals with right there. There were a couple of times when it reached that value and a couple of times when it breached it by $4 or $5, but especially compared to the last couple of years, that's a really nice point to enter this company for purchase. I'm looking at the par that would come from Manifest. Next slide, Mark. And Manifest is suggesting, based on the analyst consensus, suggesting 20% par. That's above my top total return value of 17.5, but I noticed that Manifest is using a higher sales rate and a higher average PE value than I was using. That accounts for the difference in values, in numbers. And to be honest, with a good, solid workhorse company that's medium size, that should make up half of my portfolio, I will gladly settle for 12.5 to 17% return if it happens to do better than it looks at right at this particular moment, then the sky could be the limit. You saw how high that stock did move. But I'm glad to tell you that some of the clubs that I belong to with ULTA, even though we did not see any of this coming, the high PE caused us to do a little bit of trimming in one of the clubs that I belong to. And now we'll be able to put that money back in and we'll be able to buy, 140% of the number of shares we sold off, maybe 145% of the number of shares we sold off, and the whole thing looks like a slam dunk to me and my partners. Now, you might see something that I'm missing, but I'm going to suggest we add another $1,000 into Ulta Beauty, because I think the market just got it really, really wrong this time. That's it, Mark.
I was talking to myself.
Oh, all right.
I was just mentioning that it's actually been a resident of the Roundtable Tracking portfolio for a number of years. I think the first position going back almost 7. Truly exemplary performance. And it was also the number 1 company over a 10-year period a few months ago in the S&P 500. So I think many of our community participants have actually owned this one. I continue to marvel at how a company that has displayed this type of operational consistency can be so volatile, to drop from 360 to 240 literally overnight. It's just amazing to me, but it just shows you what can happen in retail. But we'll go ahead and add a position to Ulta and continue to hope that workhorse keeps trudging along. Okay, let's go ahead and switch gears to one of Cy's computer consulting stocks. A little different opening slide for you here, Cy. I just like the picture and just this notion of how important this type of computer vision is to a consulting firm like EPAM Systems. So go ahead and take it away.
All right, I will do that, and I appreciate your creativity with EPAM, and actually, it certainly does not have the price consistency to an extent that Ulta has, and is very much of a high growth company rather than a medium growth company, but it also is a very consistent company that potentially has some volatility, not surprising given that it's a tech company and also a relatively small competitor, or at least peer in the industry to companies like Cognizant and Emphasis that we also have in the portfolio. Next slide. I started, as I do frequently with my search for the month, looking at the portfolio. Even though, like Ken mentioned, we slipped over 12% for the first time in a while portfolio-wide, I decided I would just rank by growth and see what some of our high growth companies in the portfolio looked like. And you see EPAM is one of the top 3 in growth, and also has a very solid quality, can't get much better than 98, and also a good solid par, although for reasons that we'll talk a little bit about when we get to the valuation phase, that may be a little aggressive, but I still think EPAM is a good potential buy. The other thing that struck me is that it's always nice, if possible, to take a stock that has a little bit of momentum behind it if the business outlook and pricing outlook for the company using our value-based metrics also looks good. And you can tell EPAM has that in that it's been picked 4 times and has more than doubled in value. And that's roughly from the very first pick to today, a little less than 3 years. The last time it was picked was in January of this year. So you're looking at probably an average of 2 years or so to come up that much. Next slide. Then what I like to do sometimes when I'm looking at a company in the portfolio is just go out and see if there's anything else in the database with similar or better characteristics that has a better return. You could see the criteria that I used in the upper right-hand corner, quality of 90, even though EPAM is 98. 90 is super excellent quality, so I just lowered it to 90. Financial strength of 80, rounding down a little bit from EPAM, and EPS stability. Interestingly, you notice I used 69. That was to get EPAM in. Because apparently the screener does not round, but our conclusions do round to 0 decimal places. So I just throw that out as your screening tip of the night. If you're expecting to see a company that doesn't come up because you screen at 70 earning stability, which is what I did, and EPAM did not come up, try dropping at a point. And you can see that it appears and it's at 70, but that really must be 69 point something in the database. And again, where we're going though, ranked by growth, is the top growth, and you could see out of these companies, it's also close to the highest in value. Again, can't get much better than 98, and is the highest potential return. And you notice, I guess everything down, let's see, Lulu is not in the portfolio, is it?
No.
I don't believe. Just about everything else there on the top, along as well as some farther down, are in the portfolio.
Ken will do some personal research and be bringing Lulu sometime soon.
When I buy my yoga pants, Mark, okay?
Oh.
All right.
I might wear those to teach the beginners with next May, okay?
Hey, that sounds like a winner to me.
All right.
All right, let's get in it ahead of time, front running the stock. Next slide. This is the same screen, just ranked by par, and you can see, interestingly, look at which company has just a slightly higher par according to Manifest and similar quality characteristics. ULTA Beauty that you just heard about. Next slide. Then doing a quick industry study using Manifest Info and Technology Services Industry. You see the top 3 ranked by quality are all portfolio members of the Roundtable portfolio, Cognizant, Infosys, and EPAM. And EPAM has the highest par of the 3. So for all of these reasons, I said we'll look deeper at EPAM. Next slide. For those of you who don't remember what it is or don't follow it, it's a global IT company. It's been around for 26 plus years, though not public for all of that time. It's pretty widely spread geographically, although we'll see in a minute that its revenues concentrated mostly in North America and Europe, although it's spread over 25 countries and includes both Eastern Europe as well as Asia and Australia, beyond just the Western Europe and Western Hemisphere, or not Western Hemisphere, the North American continent. Their major companies are, you see listed there, financial services, travel, business, life sciences, and then the high-tech companies are getting into that artificial intelligence and that wave type of analysis that the first picture depicted, and it has been on Forbes' fastest growing tech companies as well as Fortune's fastest growing companies. Next slide. This is just the next, I think 4 or 5 slides are from the company presentation, and they tend to update these particular slides quarterly, so you can kind of follow them along. But this just gives you a quick snapshot of the company. They've got 34 straight quarters of 20% plus growth. Actually, their compound annual growth rate, as we'll see, is closer to 23% for the last 10 years, but that's been consistent across quarters for quite some period of time. You can see the revenue by geography, 60% North America, another third in Europe, with just a little bit in the former Soviet Eastern European states, and then a little bit in Asia Pacific. Then you could see that they're pretty well diversified also across their industries, with no one industry that they support having an outsized chunk. So they're pretty well diversified there as well. Next slide. This just gives you, again, that was the revenue side that you just saw. This is the delivery side. While they get most of their revenue from North America and Western Europe, you see that most of their delivery providers are actually in Central and Eastern Europe. Next slide. Interestingly, not India, which many of the other IT companies have a similar profile, but they have much of their workforce in India. Then this is just their, again, revenues spread by their various industry clients. You see that financial services 13 years ago was zero, as well as life sciences and healthcare, very low on travel and consumer. And the travel and consumer and financial services are two of their biggest areas now. But again, they've become a much more diversified across businesses in their revenue stream. And then the graph just depicts that as well. Next slide. This slide actually was not in their latest quarterly report, but I like it because it shows that not only are they diversified numerically and spread their revenues fairly evenly across their customer base, but they deal with, not only are they an industry leader, as we saw, top 3 in quality, they are also they deal with, their customers are industry or business leaders as well. You can see top financial companies. They serve the largest online travel companies as well. Hopefully not Thomas Cook. For those of you who have heard that, and I honestly have no earthly idea whether they do or they don't, but we'll hope not. And then they also, in both the life sciences, they've got just about all of the large pharma companies and business information and media companies. That also gives you, again, a little bit of a further breakdown, drill down. You've seen the kind of the sectors or broad industries they're in. This gives you a little bit more idea what is business information and media, that they're dealing with TV networks and broadcast networks. Next slide. This is another way of looking at their client portfolio. It simply shows that they have a very stable client base. Notice what's kind of interesting is that if you look at 14, 15, and 16 FY, a significant portion of their business, ranging right around 13%, from 12% to 14%, was in one company. That's no longer the case. That they no longer have 10% plus of their business in one company. Again, it is spread much more widely, but notice that even their top companies they keep for a long period of time. Next slide. Now we get to projections. You see very consistent sales growth, reasonably consistent profitability, right in line with what you would expect from a growing company, except they've the piece that's not as much in line you would expect as a company approaches maturing, which EPAM isn't really yet showing much evidence of maturing on the revenue growth scale, but you expect profit margins to decline slightly and then kind of stabilize. You see that actually profit pre-tax margins, at least, while they did decline somewhat as the company grew, they have turned back around and actually are growing relatively significantly. The earnings drop was tax related, not surprisingly, in 2017. And then you see it rebounded, perhaps a little bit out of line, but probably about where it belongs in 2018. And then the last couple of quarters seems to be again stabilizing where it should be. I went ahead and used the manifest consensus projection of 22% growth. That's relatively significantly above Value Line. This is another example of a company that Value Line has turned somewhat not negative, has decreased their expectations on, but you don't see much evidence of that historically, and right now management guidance is still for 22 to 23% revenue growth going ahead. Next slide. This is the personalized Eagle that I did using manifest tools on EPAM. Again, you see the growth rate of 22% sales. I left the net margin just about where it is right now at 11.4. It's currently at 12%. The margin has been increasing, but of course, I should say, let me take that back. The pre-tax margin, as you saw on the graph on the previous page, has been increasing. The tax rate is bouncing around and trying to settle based on the tax reform, tax cuts recently, and I went ahead and used management's projection of 12% going forward to come up with my net margin that I used there. Then also PE ratio right now is about 43 currently. Manifest consensus is 42.5. I'm sorry, that's the current, but manifest projection is still around 40, if I remember correctly, for projected PE. What I would point out in this company, my projection, which you get down at the bottom of 13% return, which in this current market environment is a very healthy, solid, over 5 points above my par return for a company that has performed very well and has very aggressive growth prospects. But notice that projection calls for a decline in PE of about 25%, from 43 down to 34%. That's a significant drop. That's likely to happen in one of two ways. It can be a price drop that's significant, as ULTA suffered. That happens sometimes. The other way that for high growth companies it frequently happens is the price stagnates for a while and the earnings catch up with the stock price and lowers that PE ratio, and you just have a period of price stagnation. Which is it going to be in EPAM's case? I don't really know. Or could it be that the manifest consensus is correct, that the PE ratio will continue over the next 5 years to bounce around that 40% range? And if so, you notice a potential high return of 19%, according to manifest. And even my high PE projection on my stock selection guide is a 17.6% return. So the Eagle you see in front of you, I think, is very realistic for this company, but is on the conservative side of realistic, and there is certainly some significant potential for upside surprises, which I like. So EPAM's my choice this month.
Okay, we'll throw another EPAM log on the fire also then. All right, I'm going to take us out of the portfolio and go searching ultimately for a company that's not in there yet. I had some fun today going with something I've been looking at over the last several weeks. Cy mentioned that he doesn't spend a lot of time with RSI, That's relative strength index, which is just a momentum indicator and can lead us to situations where a company's just been beat to death or a beneficiary of exuberance. In this case, we're trying to find the company where Wall Street has basically just beaten it senseless. You can see that Ken's ULTA Beauty actually makes this list. That huge downdraft in price is probably a case of the pendulum swinging too far. So we're looking for that type of situation. Company at the top of the list, in this case, is FedEx, ticker symbol FDX. You can see that the analyst projections have a projected return in the mid-teens at 15-ish. Pretty good quality at 87. That's right in the middle of the excellent zone. You can see that the relative strength index is down around 30. And then we also have a situation where it's trading fairly close to its 52-week low. A little bit more on that and where this comes from in a second. The value line expectations for FedEx are pretty strong, coming in at a long 3 to 5 year forecast of over 20%. Owner's return on capital, again, that's the pre-tax profit margin divided by the capital going into it today, pretty good at 15.5. Morningstar thinks it's on sale at 77% as far as the price to the fair value. The analyst consensus agreed, and a fairly decent expectation over the next year. I formed this screen by basically taking a look at some of the work we've been doing with relative strength and Hugh McManus's favorite of shopping near the 52-week low, hence the tribute to Irish Spring. So the position in the 52-week position is literally, where is it on this scale? In this case, FedEx is down here very close to its 52-week low, trading in a good spot compared to its 52-week price target. These are all in single digits. We like to see them in single digits, certainly less than 20. And all I did was combine those with the relative strength index, which shows up on the stock charts at the top. You can see the times in the past when FedEx over the last year or so has dipped down into that oversold region of 20 to 30. You can see it's getting back down there again. And so that's where that number comes from. And I basically just took and added these two numbers together and said, well, who has the lowest combination of these two pictures? And I really like the prospect of FedEx and the fact that it's probably been punished, as Ken pointed out, much like ULTA, a little bit too much. At the start of the session tonight, Cy mentioned that every once in a while, Value Line will have dramatically less optimistic projections for many types of companies, and I mentioned that sometimes the younger or faster growing emerging type companies fit that bill. And right now, and I think Netflix falls into that category. Netflix has, according to the analyst consensus, very strong expectations, but you can see that Value Line gives it a sigh. That's S-I-G-H, not C-Y, a sigh. And you can see that Morningstar dramatically disagrees. They actually think it's dramatically overpriced. And then you see the analyst consensus coming in with it being dramatically underpriced. That's one of the bigger differences between those two numbers I've ever seen. But again, the type of thing that you can see every once in a while with Value Line and Morningstar, and in many cases, better investing-based analyses also for younger companies. So just something to watch for and just be at least aware of. Some other pretty decent names on this list. I presented Limoneira a few months ago. It still qualifies for the list. It now has my permission to increase and disappear from this list, so let the stock price go up. I also use this as an excuse to point out a column that I actually put out 15 years ago on Federal Express. And this is a column that I received more letters, almost as many letters as Hugh got when he criticized Pfizer back in the late 19 or the end, right around the turn of the century. And some of you probably remember this from the back page of Better Investing magazine. All I did was point out that there's an arrow or a pointer in the logo right there embedded between the E and the X, and now many people can't see anything except for the arrow, and they send me nasty emails. And just thought I would have some fun with that tonight. Here's a reminder that again, since
You were a trend. You were ahead of your time, Mark, because I just saw. I think when I was up in Asheville this past weekend, a show where they were commenting on business logos, and FedEx and the Arrow was one of the ones that they mentioned.
there you
So
go.
they stole your thunder.
Well, I was 15 years ahead of them.
Right.
Good stuff. All right. So just a reminder that prices zig and prices zag. Federal Express, ever since that article came out in late 2004, you can see it's had its moments with price. Here is that terrible period, very recessionary period that we pretty much like to forget about. But yeah, the stock price actually did take a pretty big dive, probably overreacted to the situation back then. You can see that the relative strength index actually got down to 20-ish. And I just point this out because over that period of 14 or 15 years, there's only been a couple of times back here and then here since about Christmas, that Christmas downdraft, and right now that we've been down in that oversold condition. And you know, if you had steely resolve and got into this company back at a stock price of 30-ish, back in 2009, early 2009, it went from 30 to 120 in about a year. So you could have had that type of gain, and that type of thing can happen if you allow these type of opportunities to form before you. I have lamented in the past that I missed the Christmas shopping opportunity in FedEx, and it's back. So it's kind of like another shot at the basket. Here's some of the details on what's going on. They decided not to renew their shipping contract with Amazon a couple of months ago, and they're also going to they recently terminated the ground agreement at the end of August. But the important factor to kick in is that only represents 1.3% of their total business. And I guarantee you, the Wall Street rhinos and most investors around the country don't understand that what these guys have actually decided to do probably makes their business healthier and allows them to focus in some other areas that were staying away from them because of their affiliation with Amazon. And I think it's going to be fascinating to watch. Kevin Downey, the value line analyst who covers the company, agrees. Although there's going to be some uncertainty and untimeliness to this, long-term investors, that's us, may want to take a closer look here. And again, for the reasons that we were just talking about, a couple articles on the Manifest Investing site in the forum. If you want to take a look at some of the details going on, here's a link to that Better Investing article. And here's some of the more recent stuff that's going on. Now, FedEx just missed their estimates by literally a dime, and the stock dropped 9%. So again, some of what Ken was talking about, how this stuff can get kind of crazy. Companies just barely missing their expectations or giving slightly lower expectations, and they just get completely hammered. I think it's, again, a case of the rhinos pushing the pendulum too far in many of these cases. Here's the business at FedEx. Again, over the years, very steady, very, very not the type of double-digit type growth that Cy was just talking about, but we're talking about a company, a mature company, growing in that 7 to 8% range, maybe even a little bit higher than that. You can see the earnings hiccup that has come around in the last year, and that will cause some price pressure to the downside. But you also see some recovery that is projected on the right-hand side of this. You can see that their net margins have come under a little bit of pressure in the recent years. But again, nothing earth-shattering or certainly catastrophic about it. You can see that as the company has matured, the PE ratio is tracking and trending towards something in the low teens. Again, not catastrophic. So again, you're talking about a company that has dropped down in price, $70 billion company growing at 6 or 7%. Again, nothing wrong with that for a quality company. The projected net margin, somewhere in that 6-ish range, certainly agrees with the picture that we're seeing here. Equity ratio, again, on the conservative side, somewhere in that 11, 12, 13 type range, generates a projected annual return, the return forecast of 15%ish. So again, a fairly solid number for a core holding within many of the portfolios that are out there. You can see that they have a little bit of debt, but they have a fair amount in the checkbook also. At Manifest Investing, we use as one of the measures of the financial strength of the company, we'll actually take a look at the actual annual interest paid, compare it to the long-term debt, and come up with an effective interest rate, kind of like the mortgage. And for them, you see that they're basically borrowing their money for 3.37%. It's a pretty powerful number, considering that the average company checks in at somewhere around 4.75. So again, when they go out and borrow money to fund their operations, they get it at a very attractive interest rate. That's a powerful signal of solid financial strength. Relative strength, again, approaching 30, so possibly oversold. And you can see that the low price forecast from Value Line is $305. That generates a low total return forecast of 21.6%. That's pretty positive stuff. So here's a look at the equity analysis guide for FedEx, much like Cy and Ken have actually taken a look at. It is kind of a mild triple play situation. You can see, again, $70 billion company growing at about 6.5%, becoming nearly a $100 billion company in 5 years. Again, we're talking September 2024. The net margin actually increasing slightly up into that 5.9% range, consistent with that graphic that we saw, very typical, very much like Section 2A on the stock selection guide. Like Ken had with ULTA, a decrease in shares outstanding. They're going to buy back some of their shares. The net result of that is earnings of $23. You can see that the current PE, thanks to that hammering of the stock price, is down in single digits. And you can see that we're using 12 for our expected average PE. All of that leads to a 16.1% return and a very favorable condition. So again, the triple play is positioned to give a decent return, showing the potential for margin enhancement, even if that's kind of vanilla margin enhancement. But again, as I was saying with his company, EPAM, you're looking at almost a 25% increase in PE ratio that can be reasonable. Again, just recognizing that the company has been hammered here of late. So all of those things are pretty positive signs for this potential workhorse for the portfolio, core holding, stalwart, triple play situation. It all adds up for me to an opportunity to accumulate shares of FedEx going forward. So I think with that, we'll skip over our Delix moment, other than to say we've had a lot of fun. If you have any questions about that, please send them. But our Delix has actually had a pretty good run here over the last month or so. It's turned into one of the better performing positions in the entire portfolio. In a nutshell, they got approval since the last round table that's mentioned here. And Hugh does believe that the company is still very attractive to another partner or an acquirer, and some really good news, and it's just kind of behaving. I blame a lot of the recent price action on either people capturing gains. In some cases, people are taking some January effect tax-related losses. It's not behaved very well in the last few weeks, but it's been quite a run. All right, so with that, Ken, I think we can go ahead and go to the poll.
And I think the poll is open, Mark. People are voting very quickly tonight, so I'm going to give them another 10 seconds or so.
Well, I think we hit them with more traditional studies tonight. So I would project that it's less challenging to make a selection for some of them.
Okay, and I'm going to close the poll and share the results. So the beauty wins the day today. Yeah.
So it's another vote for vanity.
You got it.
Vanity will not be challenged. All right. So we'll go ahead and add another position.
So I have a hand in the air. Let's see if I can find out who that is. It's Judith Carlin. Judith, you're unmuted. Go ahead.
No, it's a mistake. I didn't do anything.
Okay.
Hi, Judith.
Don't panic. Don't panic. I'm going to take your hand down then. Okay. All right. And we do have some questions we can get to now, Mark. We'll give people a chance to look at the coming attractions. If you get a chance to see Cy in Charlotte, he always puts on a really, really good show. So if you're free on October 26th, go give Cy a look for in Charlotte. Mark and I will be in Seattle on November 9th, I think is the date. Yes, it is. And our Stock Pickers Breakfast in mid-Michigan will be on November 16th. So we'd love to have any of you from the state of Michigan or from beyond, if you feel like driving, come to our breakfast. It's just a half-a-day presentation, but it's a lot of fun. It moves very quickly, and we cover a lot of stuff. Mark is going to Sacramento in February, and Mark and I will be in St. Louis in April.
Yeah, and there are some other dates that'll probably fill in. One thing that I would point out is, again, it is that time we're in the 1 month countdown to Halloween, and it is that time of year when we love to up our small company discovery. So I think Ken and I will probably be doing a webcast or some appearances somewhere out in that time frame. But again, just keep in mind that please bring us your best small company ideas. And yes, Marie Frank, thank you so much. We will be making sure that all of the Fortune 100 are included in that quest.
And I noticed, Mark, that Roy Chastain is pointing out that your Sacramento event is entitled Breakfast with the Champions. So both you are a champion as well as folks who come to see you get to eat. So,
Mark, we do have a new one in Philadelphia on April 25th.
Yep, I'll go ahead and add that.
That'll need to get on there. I'm looking at our question panel now, and Joe says that he thought that last month you had mentioned that RSI was available somewhere on the manifest site. Is that a coming feature, Mark, or did he mishear?
It's not available yet. It's in the Solomon database. Yeah, it's something that we will be bringing, but it is not currently at your fingertips just yet. It is at your fingertips anytime at stockcharts.com. And there's a couple other places too, but that's by far my favorite. Go looking for it.
Mark, I think you addressed this, but maybe John needs to hear it. Again, John Greer would like to know, are you concerned about the 48% debt for FedEx?
No. Just simply the fact that they have, I mean, it's good debt. 3% interest rate. They can certainly handle that level of debt. It's not unusual for a company in that line of business. I'm not sure how it compares to UPS. I'd be surprised if it was dramatically different for UPS.
Mark, that effective interest rate number, where could somebody find that number if they were looking for it for a company?
I think you have to calculate it. I don't know of any place where it's actually done. You take the amount that is made in annual interest payments and divide it by the long-term debt. So in the case of FedEx, that annual interest is $560 million per year, and you divide it by the $16.6 billion in long-term debt that you can see on this page. And we keep track of that for every single company.
Thank you. Mark, Bill Thompson wants to know if you've heard of Morning Brew, and if you have heard of it, if you have any reaction to it.
Yeah, Morning Brew. That's kind of a softball question. I love it. It's a business news site that's come out of the University of Michigan, and I would highly recommend just Google it, Morning Brew, and on our Facebook page for Manifest, we actually shoot out articles on this stuff all the time. And you may have seen that reference to Morning Brew on a couple of the FedEx articles. Really enjoy the writing. Some good, snarky type stuff comes out every once in a while. But that's what this Morning Brew, these are actually 2 articles. So yeah, I'd highly recommend you take a look at it. I will read that before I read the journal.
Mark Michael Campbell wants to know your email address. Can you give him a good email address, please?
Yep, markr@manifestinvesting.com. You see it right here.
And then Pam has sent us an idea for the small cap idea. She's giving us biospecifics technology, BSTC. Pam, if you go back to a couple of roundtables prior to this one, you'll see a presentation on BSTC. I've brought that one to the roundtable as well. So we're glad to have ideas like this. If you come up with anything, just drop Mark a line, drop me a line, and we'll be sure to add them to consideration for our list of the best 100 or the best 50 or however many we choose to put on the list. Mark Herb Barnett from Pittsburgh says, your earnings per share line for FactSet, for FedEx is significantly more even than the BI data, especially the 2018 number. Where are you pulling your data from, Mark?
That data is from Y-Charts, and they actually have a significant number of different flavors of earnings. We pick continuing operations that have been normalized or adjusted for events. So it's going to resemble the value line data in many, many cases, and it is corrected for some of the one-time events.
Okay, and the source again, Mark, is?
We're actually using Y-Charts, which is, it's actually Morningstar, but it's the Morningstar data that is continuing operations.
Okay, I'm looking at my questions box now, and it appears I've cleared that out. I don't see any hands up in the air. I'm going to kind of count to 10 in my mind because that's a sure indicator that something will come, but they're staying clean. So with that, I'd like to thank everybody for coming this evening. Special thanks to my friends Mark and Cy. And let's move on to 10 full years of this roundtable thing going on here. Okay, Mark?
All right. Well, thank you so much, guys.
That sounds great, and I hope to still be your friend next month, Mark. Go Braves.
I might invade Atlanta. I'll come into town wearing red.
Good night, everybody.
All right. Good night.